So as we turn our attention to Europe, it's important to look at, what are some of the common threads that we're seeing? And some of the common threads that we're seeing are this movement in terms of inflationary pressures to the upside, some weakening in confidence, but nothing is exponentially dropping. And that's the key thing that we keep talking about. Now, where we say that the U.S. economy is going to contract by negative 0.5, negative 1%. We think that Europe is a bit worse and is closer to negative 2%, and only really because, well, I should say multiple reasons. One, the consumer is much weaker there. Two, they rely more on exports, which are down and unlikely to come up. They'll probably get a bump from China, that's for sure. But again, more of that fade. And then their ECB is going to have to get more aggressive because their inflation is going to stay worse as a lot of these commodities essentially re-rate higher, and re-rate pricing wise, which again keeps that bid in pricing, that keeps that movement in inflation accelerating actually higher and then staying there much longer than even in the U.S. So I compared, we have the CPI from Jan, which you can see was, the CPI month over month in January was negative 0.2, but the CPI in Feb was 0.8. So it was expected to be 0.5, came in at 0.8. You look at CPI year over year, expected at 8.3, came in at 8.5. Core expected at 5.3, came in at 5.6. Again, that acceleration to the upside, which is what we were discussing throughout late January and February when we looked at just some of the normalization. January saw prices come down year on year, month on month. We're going to look better. But that pivoted and changed in Feb. And again, that's some of that drive that we've talked about. Then you look at the confidence side on the consumer, economic, industrial, all of that coming in well below expectations. And then when you look at the manufacturing Eurozone, expected at 48.5, came in at 48.5. So it's contracting, but again, just kind of sideways. And that's some of the key pieces that we've talked about. Not any real improvement, just some weakening behind the data outside of just PMI. Then you look at Germany, private consumption expected at negative 0.6, came in at negative 1%. Government spending, better. Again, that was what helped. Capital investment came in below. Expected it to be at negative 0.6, came at negative 2.5%. Therefore, GDP quarter over quarter was expected to be at negative 0.2, came at negative 0.4, pulling down year on year to just 0.3, which is what we've been talking about and why we thought Germany was, again, worse than what was initially announced. Consumer confidence still staying weak at negative 30.5, slightly better than Feb, but again, meaningfully not so much. Import price index has gotten a slightly better, but it's still it didn't fall as much as it was expected to. And that's the biggest concern that we have because this was January and we already know February ratcheted back up to a degree. So it's just going to keep that problematic piece within it. Manufacturing in Germany slowed even more. It was expected at 46.5, came in at 46.3. So again, not much changing in a positive way as CPI accelerated once again, expected at 0.5, came in at 0.8. And you're seeing all of that continue to move higher. Now, France, not a whole lot different. Consumer confidence slightly better than estimates when you look at CPI. Coming in fairly warm, expected to be at up 1%, came at up 0.9. Year over year, obviously seeing that reacceleration. Consumer spending surprising a bit to the upside on the January front, but was a bit worse in December. So again, just kind of balancing it out. PPI saw an acceleration. What last month was in December was 1.4, revised to 1.2, coming in at 2.7. And then when you look at the GDP, fairly in line. The problem was manufacturing PMI got slightly worse and is already worse than Germany, so it was expected at 47.9, came in at 47.4. So again, mixed bag, but still all of them showing some form of contraction as inflation kind of moves a bit higher, which creates more of a bigger issue overall. Spain, total mortgage lending coming down, not a huge surprise. PPI improving a bit, came in at negative 2%. CPI accelerating though in Feb, expected at 0.7, came in at 1%. CPI, same thing, year on year. Core, another acceleration. And that's some of the concern that we have in terms of some of the numbers in general, especially in Spain with some of the acceleration. But on the manufacturing side, expectation was for 49, came in at 50.7. So there's a little bit of that mixed bag in terms of we had some pretty big slowdowns in December. Some of that turned back around in January, and that's where we see some of that people feeling a bit better about the situation. But again, we don't see a huge turnaround here. Italy, consumer confidence, manufacturing, economic getting slightly better or in line. Industrial sales, again, fairly in line with where they was expected in December. They get a bit worse in Jan. Manufacturing PMI was expected at 51, came in at 52, but deficit to GDP higher than expected, coming in at 8%. GDP annual coming down at 3.7%, with the budget balance at negative 14.7, again doubling from the previous month. As CPI accelerated again, month over month was expected to be at negative 0.3, came in at a positive 2, and pushing again the year over year back to about 10%. And that's going to weigh on that sentiment. And that's why it's a matter of when are you asking. So as the sentiment gets better, typically when you look at CPI, a CPI worsens, that's going to make PMI and some of that confidence worse the following month. So because of CPI where it is in Feb, March numbers should get a bit worse. And again, that's why it's good to look at these multitude of levels. Market pricing for the ECB, again, continues to move up. I don't think that's any surprise. People are just finally now starting to get some of this understanding. And you can see how it continues to waffle back and forth. But net, the expectation that you're going to see an ECB rate after the July 2023 meeting at 3.7%, I think is very likely. Firm selling price expectations have come down a bit, but they're still expanding. And you actually saw that reaccelerate again when you look at some of those movements on the CPI side, as more companies expect to raise prices than lower them, trying to make up for some of these bigger losses. German GDP, again, the trend is moving in the wrong direction, lower highs over the last couple of years, and now you're getting that movement down. As consumer spending, I think, is the biggest concern, because real wages did not improve, and even nominal wages didn't improve in Europe the same way they did in the US, and that's going to put additional pressure to the downside. Spain expected to be at 5.7%, came in at 6.1. Again, France, same thing, expected at 7, coming at 7.2, that acceleration up. But an interesting way to look at this is peak inflation broadening again. And when you look at the numbers, you get inflation and you're getting more things going between 4 and 8% or above. That's a big number. And that is a fairly shocking number when you look at how there was a hope you were going to get a bit of a slowdown. Instead, it's just staying up here, which is why BASF and large international conglomerates are looking at this saying, well, should I stay here? Is there a point in staying in Europe, in this country, or should I shrink my footprint and go to a place that has something a bit more stable, especially on input costs, with Germany showing something similar? There's no stable core inflation in January. It was always too good to be true. And I think that's funny, because we've been saying from the beginning, inflation isn't over. Core inflation isn't over, especially in Europe. And when you look at these estimates from the beginning of 2020 all the way through, we never believed these absurdities about inflation, about some of these pieces of it's transitory. It's not transitory. If we didn't have years upon years, decades of stimulus prior to this, sure, this could have been transitory. But we do, not transitory. So now when you look at private domestic demand plunged in Q4, we don't see much adjustment. As you can see, when you look at consumer confidence, not a lot of confidence in there in general. And then the France consumer confidence moving down once again. And then the Eurozone quarterly inventory changes moving back up. And again, we're not seeing too much of an adjustment here, but the inventory side, just in terms of some of those levels, will actually be a positive, just based on some of the GDP numbers, but that's going to be an important one to watch in general. So when you look at the inventory change, it also shows you that very few people are buying stuff, coming back to our weakness in buying, our weakness in real wages, and some of those pressures on the consumer side. So that's what we have for you in the European front. In the next segment, we're going to go deeper into Asia and then obviously kicking off with China.